get started then. Thanks for joining us today. I'm excited for you all to be a part of this webinar as you will find it highly informative. Cryptocurrency and digital assets are a hot topic in the financial world, and yet many people don't have a full understanding of what it actually is and all that it encompasses. So our speaker today is Chris Moen. He is a wealth advisor here at Alaris and located up in Grand Forks, North Dakota. Chris often gets questions about crypto and is very well versed on digital assets. So he's going to help educate us on what we need to know. I'm your host, Jennifer Louie, and Jessica Jackson is going to serve as our moderator today. So you're muted for this webinar, but you do have the opportunity to ask questions by submitting them through the Q&A function in the webinar. And you can access this by clicking those three buttons at the bottom of your screen, and that will pop up the Q&A chat. And so you can submit those questions throughout the webinar, and we will answer those at the end. Couple other items. If you want to change the layout of your screen, you can do that by selecting this button at the upper right. That will give you a couple different layouts for watching the webinar. And if you need to adjust your audio, that can be done down at the bottom here by selecting that upper that arrow next to the mute button. The webinar is being recorded, so if you want to re-listen to it or share it with others, it will be accessible tomorrow at our Take Flight webpage. That's at alaris.com/take flight. And you can access any of our previously recorded webinars on this site as well. And you can do that down at the bottom here, access those educational webinars that we've done in the past. At the end of the webinar, we'll present you with a survey. We do love to hear from you. Getting your feedbacks helps us to make sure that we're bringing you topics that are of interest to you and will help us keep improving your experience. All right, so Chris, I think the general public, myself included, know that crypto and digital assets, we know it's out there. But we really don't know what's always going on underneath the hood. Even the language and the terms that are used when talking about it are unfamiliar. So I'm just going to hand it over to you, and you can help educate us today.
Yeah, thank you, Jennifer. So today, really, I'd just like to serve as kind of a high level, not overly technical, conversation about Bitcoin and crypto assets. We'll scratch the surface on some of the more technical terms, but we'll try and avoid getting too far down a rabbit hole. Just to more or less have a better understanding of what these are if they come up in conversation, and also just so you can have a good idea on things that maybe you should watch out for as well. So today's discussion is not either for or against crypto or Bitcoin or any digital asset, and definitely not any kind of a recommendation as well. So we're going to start out just talking about crypto in general, digital assets, what they are. We'll try to separate some of the fact from the fiction, because we all know there's lots of fiction out there. We hear things or we maybe see things on social media. Really important that we understand the risk of cryptocurrency and digital assets. And also, do they play a role, and what is that role in 2026?
So I had always thought of anything labeled crypto was just currency, but it's much broader than that, right?
Yeah, that's absolutely right. So crypto would be one form of a digital asset, and we'll kind of get into the different versions today. Right now, we'll start out with the overall cryptocurrency in general, and then we'll kind of move on to Bitcoin since it's the most familiar. It's been around the longest. It's kind of what started this entire growth of the digital asset space. And then we'll kind of move on to digital assets in general and the overall blockchain. You'll hear that word thrown around a lot as things around the blockchain. So what does that really mean?
Okay, so here's the nuts and bolts.
All right, so cryptocurrency is just a digital asset secured by cryptography. Now, that's another kind of funny word, maybe a little bit technical, but it just means really advanced math. And that's recorded on a decentralized, distributed ledger called the blockchain. So that's a mouthful there in that sentence. So we're going to kind of break those down below as well. So as I mentioned, cryptography is just really advanced mathematical code. Think military grade security. That's what it would take to crack this kind of cryptography. Now, decentralized just means that there is no single person, bank, entity, no government controls the systems. There are many, many thousands, typically, if not millions, of computers that are all together on this decentralized network. Now, as an example, maybe of something that you've seen in the news where this decentralized, feature of Bitcoin or cryptocurrency has come into play. A few years back, there was a trucker strike in Canada, for example, and various government institutions kind of blocked access to funds through traditional checking accounts. Well, they were able to use a decentralized network, in this case, Bitcoin, to still transmit funds, even though maybe some centralized authority would have stopped it otherwise. So that's kind of what some people would look at as a benefit to having a decentralized network, is it can't be stopped. Now, a blockchain ledger, is just a series of blocks. When you hear the word blocks, it sounds like, building blocks, like wood blocks for a kid. But really, a block is just another name for a big bucket of data. So when you hear the blockchain, it's just each block contains a lot of data, whether it be on transactions, recording ownership of something. And when you hear chain, it's just how all these blocks are connected amongst all these thousands of computers. So it's just one large ledger that's essentially time-stamped. It's a very secure ledger, so you can't manipulate it once it's been on there. And it is secured using that cryptographic hashes that we mentioned. Now, consensus mechanism, this is just how do we gain consensus between all, say, million computers on this network? How do they all agree? And that's just where, in Bitcoin specifically, is one of these. It's called proof of work. So proof of work just means all these computers are using a lot of energy to continually, these Bitcoin miners, for example, that we'll get into, have many chips that are constantly validating the network. So the proof of work uses all of this energy in order to transmit and to validate these transactions. And the security is that each one of these computers has to also be trying to crack these small digital puzzles, if you will, in order to make them gain rewards. So at the end of the day, this consensus mechanism is really just a really high energy intensive, very expensive way of creating security, so nobody could come in and just hack the system. Otherwise, it would cost them billions, if not trillions of dollars to buy enough energy to overwhelm the system. Now, peer-to-peer transfer, that just means what it sounds like. You can send money, you can send information directly from person to person without any other middle authority in there whatsoever.
Who knew that this was all going on behind the scenes,
It's a
right?
lot of things for sure.
Okay, so the one that we're most familiar with is Bitcoin.
Absolutely. You'll see it in the news quite a bit. It's kind of the OG original from back in 2008. October 31st is when the Bitcoin white paper, which is just a fancy word for why Bitcoin should exist, what the code is, and the rules for it existing. So going all the way back to 2008. So Bitcoin is, just like we mentioned with some other cryptocurrencies, completely decentralized. There is no one person that can control it. It's borderless, meaning it's completely global. And it's designed to work anywhere that there's, connection to an internet. It could be all the internet in the world goes out, but there's still one modem somewhere that connects. That would be enough to keep the network going. Now, speed, this can be a little confusing because with digital assets specifically, or even stable coins, sometimes the benefit is lightning fast speed, right? With Bitcoin, these blocks, they're issued over minutes. Now that still is very short when you compare historically to move money, let's say from the United States over to Europe somewhere. That could take a day or two using like the SWIFT network that most banks would use. Now with Bitcoin, it's minutes because they want to have it short enough that it's a benefit, but they also want to have it long enough that if they were able to identify the network of all these computers, notice that there was a bad actor or somebody that was trying to put some malicious code into there, they would be able to back that out and stop it and kick it out through their consensus mechanism. So that's why it's minutes. It could have been designed to be seconds, but they wanted to have enough time to always react to anything that the blockchain would not want to have on. Now, a big feature of Bitcoin is that it's fully transparent. Now, some of you guys might be thinking, well, I thought cryptocurrency was something that, was used for occasionally illicit things, or you'll hear the the Silk Road back from the origination of Bitcoin back then. What we found is everything on the Bitcoin blockchain is completely recorded. So it's actually a preferred way of our government to see any kind of a transaction. You always know exactly where it came from. There is no way to hide or obfuscate that data. So it's great that from a transparency perspective, it's always on the blockchain and it's always forever that you could access that record. Next huge part of Bitcoin is that it is a fixed supply. So with Bitcoin, there will only ever be 21 million Bitcoin created ever. Now that's by design because the founder of Bitcoin that created it wanted to make sure that it was something that couldn't be printed, ongoing, like say the dollar or fiat currency. They can always print more, which might lead to inflation. With Bitcoin, it's a hard asset that nothing can ever be created more. So it's deflationary in that regard. Proof of work we talked about a little bit. That's the consensus method that Bitcoin uses. It is also one of its biggest strengths. So from a energy consumption, you might hear some negative press on it takes so much energy for these Bitcoin miners and these large data centers to back up the network. Again, that is actually by design to help the cryptographic security because it would cost trillions of dollars for a bad actor to create enough power plants to say try and take over 51% of the network. It would be virtually impossible just due to the cost of it. So that's why the proof of work is such a benefit for Bitcoin. Now, Bitcoin specifically, as we mentioned, it has been around for a while. It's kind of stood the test of time. It's 17 years old. October 31st, that white paper came out, and soon after, the following January, that was when the first Genesis block, the very first block of Bitcoin, was created on the blockchain. Now, why would you ever want to have Bitcoin? What are the use cases? That can be debated, from many different angles. But historically, people use it for currency. Let's say if you're in a country where their dollar is not functional any longer or hyperinflation has occurred, you could use Bitcoin to transact and purchase things at stores or groceries or what have you, send money to family as an investment potential. Now, again, it's extremely volatile, but when it started, it was, pennies. And now as of today, it's about 68,000 per Bitcoin. So there's been a long history of up and down volatility and big price jumps. A potential store of value, and I say it's potential because of that volatility, it might not feel like a store of value, but sometimes people feel like over time, since it's a hard asset that can't be created more of, it will hold its value as opposed to things that are more inflationary. And lastly is just security, and that's because of that cryptographic security that it uses to protect the network.
So outside of Bitcoin, there's actually a lot of things that I didn't even think of that are considered digital assets.
Yeah, absolutely. So we've talked about cryptocurrencies and Bitcoin, but one of the probably more public things that you're seeing in the news and through governments right now is the use of stable coins. Now, that can sound kind of weird, like, would you invest in a stable coin? No, you would not. The purpose of a stable coin is to be pegged to the US dollar 1-to-1. So how that's accomplished is the issuers of these stable coins are buying billions and billions of dollars worth of US treasuries. So the US treasuries are backing up the stable coin, so it has a 1-to-1 peg. So this administration, for example, currently is a massive fan of stable coins because it does create a market for US treasuries globally. Stable coins can be used from businesses to send money, to and fro. It can be used to have faster settlements. So it's something that is definitely growing. And you may have heard of the Genius Act that was passed through legislation that made it so these stable coins could kind of grow larger into the economy. Now, NFTs, that's kind of an interesting one that you might have heard of. When I think NFT, I think of like a pet rock picture. There was a bunch of cases where there was a cartoon or a monkey and it sold for $10 million. And you might be thinking, like, how is that even possible? And how does that make sense? Well, the idea of an NFT is really a non-fungible token, is a fancy way of saying I can cryptographically on the blockchain guarantee that this picture or piece of art is the original and it's one of one. There cannot be a replicated one because it is on the blockchain. It is recorded and it's immutable. So NFTs are used for many different types of art to show that this is a stamp or a certification, if you will, digitally, that it is guaranteed to be the original. We're also seeing NFTs used for things like concert tickets because you don't want to have multiple tickets get sold for the same seat. So NFTs are being issued on the blockchain to say, yes, you are in this seat and it is your ticket. And here's the value. NFTs are also used kind of more and more commonly in video games. So if you think of in-game awards or in-game items that you can purchase, usually they're using an NFT, like a digital representation that you own that particular item. So very interesting. It's a whole nother world out there in NFTs. I won't get too far into it, but you'll probably hear more and more about it as time goes on. Digital files are considered digital assets. So I think most of us at some point in time have maybe sent a PDF. That's just another fancy word of digital asset, right? So all these things are combined in that definition. And lastly, it's starting to get more and more prevalent is tokenized real world assets. So tokenized is just a way of saying there's a digital token that's on the blockchain that represents a real world asset, like, for example, real estate or title to real estate. It is used to show ownership of something digitally. So we're starting to see title companies that occasionally will use tokenized ways of showing ownership and transmittal. We're also seeing ways of fractional real estate holdings because when it's tokenized, you can break it up into fractions. So for example, a piece of tokenized real estate might have 100 different investors that owe 1/100th of a big house, right? Maybe they rent it out, but they would be able to own a certain percentage because it's been tokenized. So if you hear those phrases, that's just kind of what that means in regard to tokenized real world assets.
Okay, so Chris, fungible was a new word for me. So I looked it up, and for just to help our audience, fungible means completely interchangeable. And so this is a non-fungible token. And as you were saying, Chris, those images or those arts are not interchangeable.
Yeah, no, great. Thank you for that definition. That is a word you do not see very often. You're right.
Yeah. Okay, so we've got this, some of this stuff kind of feel nebulous. So kind of
Yeah,
tell us what's real, what's not real.
absolutely. So, this fact from fiction, going back now, what we've seen is, in particular, Bitcoin's got a 17-year history, right? So it's becoming kind of an asset class of its own that you're finding more on Wall Street, for example. Institutional adoption has really accelerated as of 2024. And this was with the launch of the spot Bitcoin and Ethereum ETF. So what does that mean? So spot just means that it's actually purchasing Bitcoin in the background to buy an exchange traded fund, which is just a way of trading a traditional asset on a regulated brokerage account, for example. Many people hold like a ETF for the S&P 500 just to follow the S&P 500 index. This is just a way of having a investment fund that's regulated that you could buy with a brokerage account that actually follows the exact price of Bitcoin because the ETF is actually holding all of the Bitcoin of all of the people that are investing in it. So the reason that's important, prior to the ETFs, people had to say hold their Bitcoin on a hardware wallet, which you could look, for lack of better words, like a USB drive. And then if you ever lost that USB drive, you would never have access to your Bitcoin again. So there's been many stories of people that had it on these hardware wallets and they lost them, and they lost millions of dollars of cryptocurrency or Bitcoin. So the thought of that was enough to probably scare anybody or somebody that's not technical. So once those regulated Wall Street ETFs came out where you could go to your brokerage account and purchase them, that's when we saw historic inflows that really did shatter all of the numbers. Going back, there's been billions and billions of dollars come into the space because of these ETFs that have come out. We've also seen a lot of institutional acceptance. So pension funds, endowments, like the Harvard Endowment holds over $100 million of Bitcoin. We've got large investors. We've got companies that are holding Bitcoin on their treasuries as a more of a balance sheet asset. And then, as I mentioned earlier, this large stablecoin growth that's being used just to kind of easily transact that's pegged to the US dollar. So out of all the things that are negative that you've probably heard, and many of them are true when it comes to potentials for scams and crazy volatility and you could lose your money, there's also a lot of things that are in the real world being used on a regular basis, and they're growing in adoption, and there's a lot more regulatory framework. So you don't have to feel like it's something that's necessarily not being watched over by our government.
Yeah, this is good stuff, but you did reference the risks. So talk about that.
Absolutely. I mean, this is something that you really can't gloss over at all when talking about Bitcoin or any cryptocurrency for that matter. It is extremely high volatility. It is not uncommon at all to have 60 to 90% annual volatility, 50% even in a day you've seen. So it can feel like an absolute roller coaster. And that is something that most people aren't wanting to stomach. Um, to some, the volatility is a feature, not a bug. With the increased volatility up and down, it creates price movement, right? But that volatility also creates something that doesn't feel stable. And many people do lose lots of money because they might panic sell when they see that volatility occur. Another thing with cryptocurrency and Bitcoin is that it's trading always on. It never turns off. So in a traditional market, from the morning to the afternoon, the markets are open. And there's systems built into place. If there's too much price volatility, there'll be circuit breakers that kind of stop too much chaos from occurring in any one day. With cryptocurrencies and Bitcoin, 24/7 trading. So if something happens across the world in the middle of the night when you're sleeping, you could wake up and very well see an 80% swing in price because it happened overnight and there wasn't as many people maybe trading at that time. So it's thinly traded and lots of reaction occurred. So you really need to be aware that it never stops. So that can create stress as well because people will be checking their phones to see the price of something and it's moving all the time. It's just never stopping. So that can lead to a lot of anxiety. With many of these cryptocurrency projects, and there's probably upwards of 10,000 different cryptocurrencies, maybe even millions at this point, since they can be created so easily, the vast majority are absolutely scams that are never coming back. They go to zero and they sit there and die. So that's something to be really cognizant of is on social media or other places, you might see a cryptocurrency project getting pumped up and then go to absolutely zero and there is no recourse and no way of having that back. So you always want to be mindful of not chasing any kind of a hot tip or an idea or a social media boost of something. If it's too good to be true, it probably is in this kind of an industry. And as we mentioned, just a lot of anxiety can be had if somebody's watching the price movement because it isn't what you're normally used to seeing for any kind of a traditional financial asset.
Okay, so in addition to the volatility though, just like all things, there are scams associated with it too. And this is really important to think about if you're thinking about cryptocurrency.
Yeah, unfortunately, in a new technology space like this, bad actors do find ways and they're consistently looking for them to take the money from you and put it into their pockets. So you might see things like fake giveaways where somebody on social media will be saying, hey, we're going to give you $1 million worth of this cryptocurrency. We just need your information on where to send it. Bad sign. That's usually a case where you will lose the rest of your money if they have access to that. You'll commonly hear something called a rug pull, and that doesn't sound really intuitive at first. But what that is people will create their own cryptocurrency project, for example. They'll pump it up on social media, they'll get people to invest. Let's say it hits $1 million in value at the time. They will go ahead behind the scenes since they have programmed this cryptocurrency and they will pull the rug and take all of those profits and make it zero. And there's nothing you can do and there's nothing you can do to get your funds back. So you want to be aware of the potential of a project like that, pulling the rug and losing all of your money. Crypto ATM fraud is something that has been pretty prevalent in recent years and I would argue is growing. If you're like me, if you walk into maybe a gas station or a grocery store, you could see a crypto Bitcoin ATM. While maybe there was a good use at some point in time, the vast majority tends to be used for scams and people that are being hacked. They're told to go to these crypto ATMs and to send money to somebody's, Bitcoin address so that they can receive their computer files back or not be hacked. Almost all of these are scams, not all of them, but majority are. So just be very cautious of that if anybody's ever telling you to go to a crypto ATM and send money. Or if you happen to have somebody that you know that's elderly that you're seeing standing at a crypto ATM looking a little confused, trying to send money to help out a relative. I know I've personally experienced that. So really want to be cognizant of that. A text scam is just when you'll get a random text message that asks you, hey, can you click on this thing to verify your cryptocurrency account or to get this cryptocurrency? Really, it's designed to, if you happen to have any kind of a crypto exchange on your phone, like a Coinbase, etc., it'll try log in and take your funds. So again, many ways that bad actors will try and take funds through digital assets and cryptocurrency because it is digital. It's easier to do. You want to be really mindful of that. Private key, that's something that can be a little confusing. I'll maybe just separate a few different terms, and I know it sounds a little technical, but bear with me. With cryptocurrency and Bitcoin, you have what you call a public key. So the public key is a string of maybe 30 numbers and letters. It's like your out there in the public address if somebody wants to send you money. So it's okay if you have your public key to say, send this Bitcoin to this public key, that's yours. What you never want to do is share your private key. Now, the public key is kind of like a little identification on the blockchain saying, this is who I am, here's where you send it. Your private key is saying, here's how you get at all of my money, and here's how you send all of my money somewhere else. You use your private key. They can look identical, same number of characters and letters, just one's private and one's public. So oftentimes those are mixed up. Once somebody has access to a private key, oftentimes all of your cryptocurrency or Bitcoin is taken. The last thing I'll focus on along with the keys is something called a seed phrase. Now this gets a little confusing to some as well, but your private key, if you ever lose it, there's always a way to create a seed phrase. So call it 12 to 30 words. And those words that people typically write down on a piece of paper, that's their seed phrase to get back their private key if they lose it. Oftentimes you'll see people trying to verify seed phrases in order to send you something. That's just a way of them getting access to your private key. So be cautious of that. And lastly is just some romance scams. You know, you'll meet somebody or you'll hear of somebody that's met somebody on some dating site, maybe in another country or different state, and they're wanting to travel to, you know, get together, and they want to book their flight or their trip with crypto, and they want to use your cryptocurrency or private key in order to book that. That's a very common way that people lose everything. So you really want to be really cautious of how you're holding your crypto or Bitcoin. Is it accessible to others? And do you really know how to be protected is so important.
Oh, some of these things are kind of scary.
Absolutely. Yeah, it's not for the faint of heart.
All right. So, for those thinking about crypto in their life, what do you recommend, or what do people need to consider?
Yeah, no, thank you. So again, it's neither a recommendation for or against, but it really is more of a checklist of things that you want to kind of be thinking of if you ever are kind of considering looking at this. And the first one would just be, realistically, you have to ask yourself, you know, could you afford this portion of your investments to absolutely go to zero? And would you be okay with that? Now, I know it doesn't sound fun, but you need to know that there is a chance it could go to zero. With any of these things, there is not a lot of things backing it up like you might see in traditional finance. There is, you know, power and a network and all of those things, but again, it's a digital asset, so you have to be willing to have that portion go to zero. What's the allocation of it in your portfolio? Is it overly concentrated? If so, should you maybe consider, you know, reallocating and rebalancing so you're not too heavily invested in any one area? Do you already have a diversified portfolio? You know, before you're considering these things, like, you should really ask yourself, is, am I in a well-diversified portfolio that could withstand things if one asset class was to have a major problem? I oftentimes hear of folks kind of going all in on something like this, and it can have a disastrous effect. So you want to make sure that you are definitely diversified. As we mentioned earlier, you know, can you handle the volatility? Now, again, it may be a feature rather than a bug, but can you handle that volatility? Most people can't, and you have to be honest with yourself. Bitcoin, cryptocurrency in general, moves constantly and has massive swings. What's the opportunity cost? So let's say, for example, you had bought in Bitcoin a few years ago and it was 120,000. Today it's around 60,000, 68,000. What was the loss that you would have had if you were in a diversified portfolio? S&P 500, for example, that's kind of hitting all-time highs. So you have to know, by holding that crypto, it's very uncertain of what the market's going to do. It might follow, you know, different cycles than traditional finance. You really want to be cognizant of that. We talked a little bit today about some of the scams, but that was just honestly scratching the surface. So you really want to know, if you hold any of this, Are you secure? Do you know what to watch out for so you're not a victim of identity theft or crypto theft, etc.? Now, where is it held at? This part can get to be a big conversation, probably larger than today, but you've got options like the cryptocurrency exchanges, Coinbase, Gemini, etc. You've got the brokerage accounts that you could purchase it on the ETFs. You've got places like PayPal, Cash App, Robinhood, all these places you could hold either direct spot Bitcoin, the actual asset, or a ETF that represents it, an exchange traded fund like we talked about earlier. So you really need to know, how am I holding it and where is it actually held at and what does that mean from a security standpoint? The next one, the custody, we touched on this a little bit earlier, but that can either be physical custody, like meaning you have it in a hardware wallet. You'll sometimes hear that called cold storage. There's all these phrases that are out there, but that just means you've got your private key and all of the Bitcoin or crypto that you own is on a hardware wallet USB. That would be physical custody. You hold it. It's not relying on anybody else. Problems with that is if you lose that USB drive, or if your kid throws it in the garbage by accident, it's gone forever and you will never see it again. Now, a custodian would be more like a brokerage account or a Coinbase exchange where there might be less of an opportunity to say lose it, but you also have to trust the security of those custodians that they can hold it and not have that risk. So probably the biggest thing is I'd recommend is just talk with your advisor about it. In the past, I would say it was pretty common to have some advisors maybe not want to even address it or to just kind of put their head in the sand and look the other way. The reality is you're hearing about it in many places, right? So people would maybe hide that or hold that or not bring it into the bigger conversation, but really you want to know holistically across your portfolio, what is everything's job? What's its purpose? What's the concentration? By having that open conversation, it's going to really help a lot to know if you are really truly overextended into one area or not. But you can't really know that without ever talking with your advisor or at least trying to get some input on it. So that'd be my recommendation, is just don't be scared to bring it up. It's been around long enough now. I'm sure they've heard it and they've talked to other folks that have it too. So definitely don't feel bad about it. Just be open, and we're always happy to talk about it and not make you feel bad whatsoever.
Thanks, Chris. Really good information, and I'm sure our audience had a lot of new learnings. And why don't we find out if there are questions? Did some come through, Jessica?
Yes, I do have some questions for you, Chris.
All right.
The first one relates to, you mentioned that has a 17-year history, and you talked a little bit about the founder. So, who started it? Where did it come from?
It's a fantastic question, and it is one of the most interesting and mysterious things about Bitcoin specifically. So back in 2008, there was a white paper, as we mentioned. It was just a document that explained the purpose for Bitcoin's creation. The individual's name that started it was Satoshi Nakamoto. So we don't know if that's a real person, if that was a pseudonym for another name, if it could have been a group of people. And I don't think we'll ever know the answer to that question. And nobody's ever found out who that individual or group of people was. So it's very interesting in the sense that it was probably by design that they never identified who the creator of Bitcoin was, because if that was known, there would have been a lot of risk as the asset class. Today, it's a $2.2 trillion asset class. So if somebody knew the identity of the founder, who potentially had some of the keys to unlock the original Genesis blocks that were mined of the original Bitcoin, that would be too big of a risk. So by design, it's thought that that was why it's never known who it was, but you'll commonly hear Satoshi Nakamoto as the founder of Bitcoin.
That's fascinating. Truly fascinating, actually. Great. Thank you for that. The second question, and you touched a little bit on this too, as far as the reason there's 21 million Bitcoin will only ever exist. So can you expand on that a little bit more as far as why 21 million? Why not 20 or 19 or 25? Why 21?
Yeah,
Million?
that's a fantastic question. I probably don't have the specific answer because it was, Satoshi Nakamoto had a real good reason why. But the thought process was, as far as that number, it's large enough that there could be 21 million of these issued. So big enough that there's a network effect where it's not just 100 or 200 or 1,000. It's also important to know that each one of these Bitcoins like we mentioned, are about $68,000 a piece today. They can be broken down into 5 cents, 10 cents. Not getting too technical here, but those are called Satoshis. It's broken down many decimals. So it's just like a penny to a dollar, for example. But the 21 million was enough to build the network, to get those network effects spreaded, to make it so the blockchain had enough computers and validators to make sure that there was no centralized authority. Probably the more important feature of the 21 million is that no other coins can be created. It is what creates the hard asset where it can't be inflated into the future. So if there's a fixed amount of Bitcoin, and right now there's 19 million plus that have been mined or created, if you will, there's 3 million left. So that's what creates that scarcity effect by design, is that there can't just be more that are printed just to print more of them, like we sometimes see in different currencies across the world.
Okay. All right. Thank you again for that. And the last question I have for you, Chris, is what's the difference between stablecoin and Bitcoin?
Yeah, so with Bitcoin, it has kind of a combination of uses, right? It could be used to purchase things and transact, and it is commonly used for that across the world. But it could also be used for kind of a digital gold-like effect where it could be a store of value. Again, lots of volatility. It could go to zero, but it can be a store of value over time as well. And then also as an investment, if people want to see, price appreciation, that's a possibility. A stable coin is not meant to do any of those things besides transact, move money that's pegged to a US dollar, as we mentioned earlier. And also sometimes if somebody has Bitcoin or a different cryptocurrency and they want to send it or hold it on an exchange, because the price is so volatile, they will shift from Bitcoin into a stable coin. So it can be just that, stable. It's not like you go look back a week later from when you tried to take it off the exchange and now it's either up or down 20%. A stable coin allows you to shift straight from that cryptocurrency into a $1 peg stable coin that isn't going to move with that kind of volatility.
All right. Very good. I have a feeling people are processing this fascinating concept. So
It's a
that
lot
is
to
the-
digest. So,
It is.
yeah.
it is.
Yeah.
That is the last question. So
Okay. Well, if you do have questions, or if you'd like to connect with a financial advisor to kind of talk through this further, you can reach out to us either by calling our client service center. The number there is on your screen, 800-279-3200, or you can just email us at alaris@alaris.com. All right, everyone, thanks again for joining us and enjoy the rest of your day.
Thank you.